Hey everybody, welcome to Project X-ITE's Xplore workshop with Brian. My name is Scott, and Nina is here too. Oh, that's great. I am the student program coordinator for Project X-ITE, and I'm really happy to be moderating today's discussion with Brian and all the work that he's doing with Crawley Ventures. Brian, if you want to tell us a little bit about yourself and sort of get started, I think we want this to be pretty interactive. So if you want to turn on your video and your audio and talk through some of this with us and ask questions as they come up, I know Brian's willing to answer them. So we'll sort of go from there. But Brian, feel free to introduce yourself and what you're going to be talking about today.
All right. Thanks, Scott. Appreciate it. Yeah. Hi, everybody. I'm Brian Zimbelman. Yeah, like Scott just said, if you want to type in chat questions, or I'll stop periodically and open it up for questions. So make sure you're not on mute, and if you want to share your video, it's good to see your faces, but if not, that's okay as well. So I'm Brian Zimbelman. I work for Crawley Ventures. We're an investment firm here in Denver, Colorado, and we invest in a bunch of different asset categories, but my primary job is focused on venture-backed companies, so very early stage businesses, and we look an awful lot like a VC, although we have one pool of capital we invest off of. We don't have a fund. So when we get into the different investor types down the line, I'll explain that in more detail. But I got my MBA from DU back in 2011, and right after grad school, some friends and I put together a venture fund called Cohort Capital, and it was mostly guys and gals from DU, from our cohort mostly. And so we put together a little seed fund and started investing in startups back in 2011, and it was good fun, and I really fell in love with the space, and I've been doing it ever since. Grateful that now I get paid to invest in startup companies. It's not just my own money. So been doing it for a little while. Our strategy at Crawley Ventures for the venture side is really to invest in companies that are doing $1 million+ revenue run rate. And we're really focused on technology investments, so technology businesses. We've gone outside of that thesis a little bit, but in general, we love businesses that are technology focused, highly scalable, and doing, like I said, about $1 million revenue run rate. And that's because we're generalist investors. We don't know any specific vertical better than any other, and so we want the market to weigh in on the business before we get too involved. So that's me in a nutshell. You want me to keep going, or anything else you need to share, Scott?
No, I think we're all good. Just to let everybody know, we are going to be recording this meeting, and we'll share it on Project X-ITE's website and YouTube afterwards, along with anything else. And then, yeah, but that's pretty much it. Thanks, Brian.
Cool. Well, excited to talk to you about fundraising today, because fundraising is a really exciting, important, and often very difficult adventure. And so the first thing I want to say is congratulations to you. If you're on this call, you're probably interested in raising money for a business or a project or a nonprofit. And that's fantastic, because the world needs more builders and creators now more than ever. And so I want to encourage you and tell you congratulations and kudos for getting started. And so my general approach to this conversation is going to be more philosophical than practical. There are a ton of resources out there on pitch deck, and how to do the perfect pitch. And if you just start digging into Google and all the different venture firms, whether it's Sequoia or Andreessen Horowitz or whatever, they all have their own specific tips and advice for doing fundraising and pitching. But really what I want to share with you is a couple key philosophical approaches to fundraising that I hope will be really helpful to you. But before we do that, we are talking, this is being recorded, but we're talking in May of 2020. And so we are in the midst of the COVID-19 pandemic. We are all quarantined and sheltering in home. And so let me talk briefly about what I think is going on from a venture capital perspective right now. We've already seen data that venture capital money flows have slowed down. I suspect that will continue over the next 1 or 2 quarters. Investors, similar to us, are being much more cautious and deliberate and patient right now. And that's just because we don't fully understand the ramifications in the economy for the shutdown. So I think we've seen a lot of Q1 data come through, but Q1 really only had about 2 or 3 weeks of the shutdown in it. I think Q2 is going to show us a lot of really, really devastating numbers economically. We already know that 30 million people have filed for unemployment benefits. And so I suspect that Q2 and Q3 will be really difficult from a fundraising perspective. I think investors are just going to be really patient and really raise the bar on doing new deals. I do see a few new deals getting done, but I think that's the exception right now. I suspect that the later part of the year into the first 2 quarters of next year, we'll see venture capital come back with a force. The reality is there's been more money organized and put together in venture funds than ever before. That dry powder, so to speak, is still in a captive fund waiting to be deployed. And so investors and their investors, their limited partners, are all anxious for that capital to be deployed. So it will happen. But I think the next couple quarters are going to be really tough fundraising environments. So happy to answer any other questions on COVID. If there are any, let me know. I'll try to open up the chat room here so I can see your questions when they come up. So back to fundraising specifically, if there are 2 things I want you to leave this conversation with, it's number 1, to be really intentional about the process of fundraising. And number 2 is to pursue a mutually beneficial relationship. So build a relationship with your investors, whether that's an angel investor, a venture capitalist, a bank lender, or whatever. If you can be very intentional about the process, and we're going to talk about what I think the process looks like best. And if you pursue an authentic relationship, I think you'll have more success than not. So here's a quick agenda, and let's get into it. So like I said before, I think successful fundraising is really just a really deliberate, intentional process. Because the best entrepreneurs I know still have to talk to 100+ investors before they get to the term sheet that they're looking for. And that's because it's really hard to predict what type of investor gets interested in your business. It's really hard to look at a website and know if that's the right investor for you. And so I think just running a really disciplined, thoughtful process actually is the most effective and efficient way to get to the end goal, which is to have multiple investors competing to invest in your business. So it starts with casting a wide net. It starts with figuring out in your dream list of investors, who is it that you'd want to put on that list first, and then filling out the rest of the list with anybody you think might be remotely interested in your business. And by the way, I'm taking the perspective of VC and startup company. This could be the same for a nonprofit. This could be the same for if you're raising debt instead of equity. But for the most part, I'm taking the perspective of a VC who invests typically in equity in a startup company. So again, you cast a wide net, you fill up the funnel as much as you possibly can with as many people that might be remotely interested into your business. And then to the extent that you can, get warm introductions into those folks and those firms. And that's really important because my business as an investor, venture capitalist, is really a relationship business. And so if I get an introduction from a colleague of mine who's also an investor that I respect, and they make a warm introduction into you, the entrepreneur operator, then that goes a really long way. And you get, in my funnel, you get to the top of the list. And so, again, collect as many contacts as you possibly can, and then begin the communication with them. And so what I advise startups to do is to do a very quick introduction call. And so this is a no pressure, no decision kind of conversation. And so it goes something like, hey, I'm raising money for my business in 6 to 12 months, but today I would love to just spend 30 minutes on the phone with you or on a Zoom call like this, just to share with you what I'm working on, why I'm interested in this space, what I'm passionate about, let you understand a little bit about me as a person. I'd like to get to know you a little bit. And then maybe if it makes sense, sometime in the future, we can get together for a more formal pitch. So I love those kinds of calls. I love to meet people far earlier than when I'm looking to invest in their business and to build that relationship with them over time. And so that can be that, when you initiate communication with the potential investors, I like to start with a pretty low pressure, small time commitment kind of conversation. And then the other thing you can do after you get the contacts and maybe you have that first initial call with them is to add them to a newsletter. I think having a monthly or a periodic newsletter to stakeholders is a really, really effective way to keep everybody informed on what you're doing as a business. And it's really easy to signal to investors that you've been progressing in your business, it's growing, it's expanding, and you're starting to contemplate what a new financing looks like. You can signal that in your newsletter, and that helps me as an investor to get back in touch and start those conversations. So after you've collected all the contacts and you've begun in communication with the potential investors, then you start to keep working them through your funnel, and that's when the formal pitch comes in. And so it's just as important to have a really thoughtful pitch, and we're going to talk more about the pitch specifically in a couple minutes, but it's really important to also have a really great follow-up. And so, the best entrepreneurs that I know that go through this fundraising process are great at follow-up. And so they do the pitch. There are maybe a handful of questions that come out of the pitch. The best operators, entrepreneurs are taking notes, and they're following up on those questions, and anything that is communicated or agreed to at that pitch meeting, really great follow-up goes a long ways. It demonstrates to me as an investor that you're a skilled operator, you're detail-oriented, and you're great at execution. So again, as you work down the funnel, you get to the formal pitch, and you're following up. Well, then the last thing that you need to do is to drive some urgency into the process, because the truth is, time is on my side as an investor, and it's not on your side as an operator. And so the reason for that is because me as an investor, the more time that goes on, the more I get to learn about your business, the more I can understand the market, the more I can get to know you as an individual, as a human being. But on the flip side, for you as the entrepreneur or operator, the more that time goes on, potentially more cash you're burning, the more time you're spending on fundraising and less time you're spending on building the business. And so you need to be able to create some urgency in the process and drive to a decision timeline. A really great way to do that is to create some competition. And so, you don't want to get over your skis in terms of making people believe something that isn't true, but, great fundraisers are able to create the sense of competition and urgency so that you can drive to a decision timeline. So generally speaking, I just think if you sit down and you write out the process that it takes to get as many potential investors in your funnel to the timelines that you're working on to get to a decision point for the investors, if you can really write out what that process looks like, be very detailed, be very disciplined, have constant communication back and forth with everybody who's in your funnel, drive to a sense of urgency and to a decision point, you'll be successful. Because and I get this question a lot, it's like, when am I ready to start fundraising? Well, again, because there's so much capital been organized around venture capital, whether that's really, really early stage in the sort of angel investor stage or more mature, if you talk to enough people, you will find an investor who's excited about your business. So if you can run a disciplined process, you'll find those investors, you'll get them to a yes, and you'll get that deal closed. A couple other things to just keep on top of mind when you're running the process is having some empathy and putting yourself in the shoes of the investor. So understand what are their timelines. Can they make a decision in 3 weeks, 6 weeks, 2 months? How many in-person meetings do they need to get to a yes? What does their investment committee look like, and how do they run their decision process? Get to know them as a human being. And then the last point is just to build authentic relationships. And so again, if you treat this like a human being, like you are a human being and you're trying to build a relationship with another human being, it goes a long ways. If you treat this as a transaction, it comes across that way, and I think you'll run into trouble. So let me pause for a second and see if you all have any questions. Feel free to chime in and unmute yourself if you have any questions, or you can use the chat box. Okay, I'm gonna keep going then. When thinking about raising money from an investor, I think it's really important to start and figure out who that investor is, what their strategy is, and what type of investor they are, and make sure that it matches the stage that you are in. So on this chart, I grouped a number of different investor types, and these are very broad categories. Literally trillions of dollars are organized within these different buckets. And then in the middle column, I just put in, the various stages of a business as they start up. And so it's really important to match the type of investors that invest in your stage of business. And so if you're a pre-seed company, you need to make sure that whether it's a venture capitalist or an angel investor, or maybe it's a family office investor, they match your stage and they have a thesis around pre-seed, and they understand how to do a pre-seed deal. And that maybe sounds really intuitive, but you would be surprised how few people come in and talk to us, and there's just a complete mismatch between what we very publicly say we invest in and what they're trying to do. So let me briefly describe the different investor types just so that we're all clear. Angel investors are really individuals. They typically invest in the very earliest stages of a business. And so they might write a $10,000 check, $25,000, maybe $50,000 check, but it's usually a wealthy individual who wants to get exposure to very, very early stage businesses, but also wants to be somewhat helpful and probably wants to be somewhat involved at that earliest stage. And so finding great angel investors is really important at the very beginning stages of your journey as an entrepreneur or founder. And there's some groups here in Colorado that help connect you with different angels. There's the Rockies Venture Club, which is an angel investment club. There are something called Denver Angels, which is a different angels group, much different than Rockies Venture Club. Some different universities have angel clubs or angel investment groups. There's one called Chemical Angels. And so angel investors are really, really powerful, especially at the very beginning stages of your process. Once you get into more of a little bit more mature stage, you may still be pre-seed. You may be, and by pre-seed, I just mean you are, maybe you don't have a product yet, or you're not generating revenue yet, but you have a concept, you have a team, and you're building whatever it is you're going to sell. Seed is a little bit more mature. Maybe you have first revenues, or you have some beta testers on your product, all the way up through growth, which is you're generating revenue, you're building out your team, you're scaling the business, you've got indications that you have product market fit, which means that the market that you're selling into is reacting very favorably to what you're providing, what you're selling. So venture capitalists invest in all three of those stages: pre-seed, seed, and what I call growth here, which could be a Series A, Series B, Series C. That might be nomenclature that you're familiar with. And so, but again, it's really important that you go and look on the VC's websites or their LinkedIn profiles or the blogs or whatever, because they signal what it is that they look for. And there are entire funds and firms that are dedicated to pre-seed. They want to be the first check into a business. They want to take a very active approach to helping build the business. And then you have other VCs who are growth stage VCs. So they're looking for a business that's doing $5 to $10 million in revenue before they write a check, but maybe they write a 10 or 20 or $50 million check. So it's really important just to understand where the VC fund and firm is and what it is that they're focusing on. And then private equity. Private equity is a bit different. Venture capitalists in general have a higher risk reward tolerance than private equity investors, which means they're really underwriting each investment opportunity as a, say, a 10x. They want to put in $1 million and be able to get $10 million out of the business within a specific time frame. Private equity generally has a lower risk reward tolerance, and so they're looking to put in capital and maybe get a 3 to 5x over a 7 to 10 year time frame, which means they typically don't invest in early stage kind of venture backed kind of businesses. Private equity in general is more of a financial engineering engine. And so they're looking at buying businesses that are maybe underperforming or not operated well, or maybe buying a handful of businesses and putting together to make one more efficient business. And so in general, startup companies aren't typically engaged with private equity, although private equity has been coming downstream a little bit towards venture-backed businesses. Then there's this thing called family offices, which is sort of not on everybody's radar. What I work for, the firm I work for, generally is sort of a family office, but basically what that means is it's the way you institutionalize the investment platform on behalf of typically one family. It may be multi-generational, but it's typically one kind of family. And so they're unique because, number one, they haven't raised a fund, and so they have a lot of flexibility in what they can invest in. So number two, they're more likely to invest in something they're interested in and not just something that looks good on paper. And so a lot of family offices have a bit of a thematic approach, like they invest in the future of food, for example, or they might be more of an impact investor. And so they want to know that the investments they make are doing something positive for society. So it's just a different investment criteria. It's a different process, different interests. But you should know that there are a lot of family office investors out there. It's becoming a much more prevalent and much more prominent thing. So you can find family office investors sort of by searching LinkedIn and talking to other people. And you should know that there's like $4 trillion organized underneath family office structures. And so they're actively putting capital to work. Sometimes family offices are more focused on funds than direct investments in businesses. And so you just, again, need to do your homework up front and ask the family office, what their thesis is. Do they do direct investments? So those are, everything above is really focused on equity investors. And next we talk about bank debt, private debt. And so you should just know that there's a whole industry of debt providers out there, especially if you're a venture-backed company. There are typically good things to raise equity for, and then there are things that are not as attractive to raise equity for. And so, things like working capital or buying capital, equipment, funding inventory, those are things that it would serve you much better to raise debt for and not to dilute yourself and to raise equity to fund. And so there are banks out there, obviously all over the place, Silicon Valley Bank, et cetera, that lend to venture-backed companies. And then there's a whole cottage industry of private debt providers who have raised funds to lend to venture-backed companies. And so just know that that's out there when your business grows to the place that it makes sense to take on debt. There are institutional and private debt providers out there for you. And then obviously public markets. This is for a select group of venture-backed businesses that have grown really, really, really large, who want to now tap into the public markets to either raise capital. That's one outcome of IPOing. But the other outcome is to create liquidity for all of your investors. So if you invested in the Series A of a business 10 years ago and they IPO, you now have publicly traded stocks in that business that you can sell or hold on to. And so the public market was starting to heat up. The IPO market was starting to heat up last year, but it is almost completely frozen at this point. Again, if you go back to my remarks at the beginning, I think that'll unthaw towards the latter part of this year or into next year. who knows? But there are a lot of really big privately held companies that need to IPO, frankly, both for their investors to get liquidity, but also to raise capital. So that'll come back at some point in the future. All right, I'm gonna take another breath and open it up for questions. I see there's one question on the chat, but if there are any other questions, feel free to unmute yourself and chime in right now. So I'm going to read this Zoom group chat question real quick. The way I interpret it, what's being asked is, are there investors that are looking to take advantage of companies that are basically in trouble right now? So maybe a distressed business. That is absolutely happening. So in any shock to the economic system, you're going to find investors trying to take advantage of that. And take advantage is sort of a loaded term. So there are folks who will go after businesses as bad actors, try to take advantage of the person or the business in a negative way. And then there are people who will come in alongside the businesses knowing that they're struggling, but believe in the business, believe in the management team and the founder and the CEO, and will partner with that company to get them through this difficult situation. Both those things are happening right now. And so, my advice to CEOs and founders is to do your homework to figure out what are the motivations of the investor who's approached you. Is it because they believe in you and your mission and the business and they want to see you sustain through this? Or is it because they're trying to take advantage of the situation and try to get something that they think is valuable, but for very cheap because of the economic situation that we're in? Because you'll encounter both of them. And so the reality is if you're running low on cash and your revenue is drying up, there are very few options in front of you. It's really important that you have a great board or set of advisors or mentors or stakeholders in your business that you can talk through all of these situations, because it's difficult to navigate. And just personally, I'll share personally, my last 6 to 8 weeks have been calls with CEOs talking about furloughs and layoffs and needing to raise money to extend runway and looking in the face of 80% declines in revenues. And it's really, really tough right now. But investors like us, and there are lots of others, we have stood beside all of our portfolio companies and we've tried to surround them with great people. We've reinvested in almost all of our businesses. And we're going to help them survive this as much as we can. So we're obviously on one side of that spectrum. I've also advised many companies in the last few weeks who have been approached by what I call like sharks, who smell blood in the water and are trying to take advantage of the situation. And so, just know that it's all out there. Surround yourself with great people who can help you navigate it. The other question is, what are investors looking for in the pre-seed stage? So again, pre-seed is the very earliest stage. And so if I'm an investor and I've raised a fund, say a $10 million pre-seed fund, and I'm going to make $100,000, $250,000 investments out of my $10 million fund, what I'm looking for is for any one of those businesses that I invest in to return my whole fund. So if I write a $100,000 check, I need to be convinced that that business could return $10 million back to me. And the reason is because the statistics show that pre-seed companies and early stage venture companies fail far more often than succeed, especially when you think about returning capital back to investors. And so if I make, say, 20 bets on my seed fund or pre-seed fund, I need to expect that all but the top 10% are not going to either return any capital or are going to return notional capital back to me. And so that top 10% or maybe 20% needs to carry the fund. And so if I make a handful, 20 investments, I need to make sure that 3, 4, 5 of those investments are going to return my fund, so that in the aggregate sense, I'm able to have a 3 to 5x return on my entire fund. So pre-seed investors know that failure is part of the game. They know that it's very early stages, and so there's going to be a lot of interaction, a lot of working together. But they've got to believe that there's a huge outcome potential with the business. That's probably the biggest thing that they're looking for. And then the terms have to match that, right? So if you're raising a pre-seed fund, you're just getting started, you need to raise $1.5 million. So I'd say like a prototypical seed or pre-seed deal is raising $500K to $1.5 million on a, say, $4 or $5 or $6 million pre-money valuation. So again, if you take a step back and say, well, that has to do 10x or 20x or 30x, well, then this has to become a $300, $400, $500 million business. So the valuation really matters up front, because me as an investor, I need to be able to underwrite or have confidence that they could do 10x, 20x, 30x my money eventually. Great questions. Thank you. Any other questions? All right. So we've talked a little bit about the process of creating a huge funnel and driving towards a decision point with your investors. We talked a little bit about the different types of investors. One other thing that I counsel a lot of startups on is beginning with the end in mind and really starting out with a clear idea of what you're trying to accomplish with your fundraise and your business. And so you should be able to answer all these questions in great detail. Like I literally mean you should write down these questions and type out answers to all of these. And so why are you raising capital? A lot of startups feel like I should raise venture capital because I'm a startup. Well, you should only raise venture capital if you meet the venture capital model. And 95% of new businesses don't meet the venture capital model, which is high risk, high reward, being able to raise a lot of capital and grow much faster than all of your competitors. It's really the VC model. So you need to have a clear picture of why you're raising capital, your timelines to raising that capital, work backwards from there, really understanding how much capital you need and what you're going to do with it, what your use of funds is. And then most importantly, and we briefly touched on it a few minutes ago, is who's supporting me in the process. And so being a CEO of a startup company is one of the most lonely jobs out there. And it's great to support yourself with the other CEOs of startup companies. That's a really smart thing to do. But you also need a whole cadre of advisors and mentors. Project X-ITE is great because it can surround you with that. Other organizations like Techstars are great because they surround you with amazing people. So you need to just continue to build out your network of people to support you through the process. You need a great board when it's time to organize a board. And then obviously, or maybe not obviously, but you really need a great support personally. So whether that's a significant other, family, friends, make sure you don't go at this alone, because fundraising is a numbers game, and you're going to hear no a lot more often than you're going to hear yes. And so it can be very lonely. It can be very frustrating at times. So make sure you surround yourself with some high quality people. So if you answer all these questions in painful detail and really have a clear picture of what you're trying to accomplish, you'll be far more successful than if you wing it, so to speak. All right, let's transition into the pitch a little bit more specifically. And so like I said before, if you spend some time on the internet, you will find lots of ideas about the best ways to do a pitch deck, the ways to organize a 15-minute pitch, 30-minute pitch, 45-minute pitch, whatever you need to. But I boil it down to a couple of key ideas. First of all, you have 3 objectives in the pitch itself. Number 1, you need to tell a compelling story. You need to hook your audience, your potential investors. That might be an origin story. Like I've heard stories about, a medical condition that a family member has. And so this person is creating the solution to that problem. It might be a vision for the future. So, autonomy or flying cars or whatever it is. But you need to have a compelling story that captures your potential investors and hooks them into the theme. Number two, which I've said this a few times already, but your other objective is to build a mutually beneficial relationship. Like be a human and connect with the human. I get sent deals and connections all the time from CEOs of businesses that we passed on. And so this is a company that was raising money that we said no to, but we were both able to approach the process from a place of trying to build a relationship that I remain friends with many of them. We are still colleagues. We share deals, we share expertise. And I think that's really the sign of trying to approach this thing in the right way and to build effective relationships over the long course of your career. And then finally, you really need to instill confidence that this is a great investment opportunity for the potential investor. So remember, it's a numbers game for you and for me. So you might talk to 100 to 150 investors before you find that perfect one to lead your round. I'm going to talk to 100 companies before I invest in one. And so it's a numbers game, but your job is to convince me credibly that this is a great opportunity and it matches my thesis and we're going to be successful if we work together. And then, so, how do we do that? I think the most effective way is to paint a very clear picture of what success looks like. Show the journey of getting from where you are today to what success looks like in the future, and then plug that investor right into that gap. So if it's building a new product, if it's building a marketplace, if it's scaling the business, if it's hiring a bunch of people, whatever it is that you need to drive success in your business, show where that investor, their capital, but also their own expertise can help bridge that gap and help make you successful together. From the reverse side, as an investor, what am I looking for in a pitch? Three things. Number one, the quality of the team. So I spend a lot of time talking to people about their experience, their past, where they grew up, what makes them an exceptional entrepreneur. We really value diversity in our thesis, and so we're looking for people who don't look or talk or have the same experiences as us to round out our collective experience and intellect and capabilities and competencies. And so it's number one about the people, especially at the earliest stages. Number two, it's about the market, and more specifically, it's about the problem that you're solving for the market. So I'm evaluating the people, the problem that the market has, and what size is that problem. And then number three, it comes down to the terms of the deal. And so the terms of the deal have to match the risk and the reward that an investor sees in the business. And that's a totally different webinar that we can host at some point in the future. Great resources like Venture Deals by Brad Feld that really help you walk through what a term sheet and an actual purchase agreement looks like in painful detail. But really, those are the three things that I look for at that initial meeting. Confidence that the people running the business can accomplish what they've set out to do. Number one. Number two, that the pain in the market is very real and it's big. And then number three, that the terms of the deal match the risk and reward of the opportunity. All right, I'm going to pause one more time for any questions, either on the chat or online. Okay. Here's a few practical tips. So the remaining time here, I'm just going to, I've sort of, I'm done with the philosophical side of fundraising. I hope you take away a couple things. Number one, being very intentional about the process. The most successful fundraisers follow a very disciplined process. They're great at filling up the funnel of potential investors. They're great at working people through that funnel. They're great at driving a decision point. And then the second piece is to pursue an authentic, mutually beneficial relationship. Remember, you're a human, the investor's a human. Build an effective relationship and it'll serve you well over the long term. So now let's get into the practicalities of fundraising and a few tips here. I'll never forget a pitch I had where we're in a coffee shop. This person opens up a laptop and begins to literally read me the slides on the screen. Don't do that. So my advice to you is to have a conversation, engage with the person that you're talking to, learn about them, let them learn about you, share with them your story. Do not read your charts under any circumstances. Number 2, build a data room and a frequently asked question list before you start pitching. This is really, really effective. It saves everybody a ton of time, but it also shows to your investors that you're a strong operator and strong in execution. And so when you go and have a formal pitch to somebody, or even if you're just starting out the process and you haven't done the formal pitch, if they ask you, hey, do you have any more information I could dig in on? And you send them a link to a data room that's fully populated with your intellectual property, with your financial model, with your product details, etc. That goes a long way. And really for me, it's one of the differentiating features I see across entrepreneurs. And there's a really strong correlation to really strong CEOs in operating their business and then being really prepared for a fundraise. And a lot of firms or a lot of businesses will do an FAQ as well, because they get the same 10, 15 questions during every pitch and after every pitch. And so they put together an FAQ. It just really helps knock out some of those easy questions. I alluded to this a little bit earlier, but it's really smart to start to talk to ideal investors way before you want to formally pitch them, for 2 reasons. Number 1, it goes a long ways in building that relationship. But number 2, you can cheat a little bit. You can ask them in a very, informal, low pressure atmosphere, what do you look for in a business at my stage? What are the 3 things you would look for in my business to be convinced that we're on the right track? What types of deals are you seeing and what pricing are you seeing at this stage? And so you can get them, the investor, me, to share with you basically what the scorecard is. And then you now have something that you can work towards when you get to that formal pitch. I personally I don't know that I've, in the last 5 years, I haven't invested in a company where I had to get to know the founding team and evaluate the business within a 6-month time frame, or 6-week time frame. It's always been, I've been able to get to know the entrepreneur or the founders over a longer period of time, 6 to 12 months, maybe more. I've followed their business, and they have then entered into what we would define as our entry criteria for our investment thesis. And so when we get down to it, I'm evaluating the business and the terms of the deal. I've already built the relationship with the team, and I've already convinced myself that this is a good team to back. I know most investors feel the same way. So it's really difficult to underwrite a team, a market, terms of the deal, all at the same time, especially in a compressed time frame. So meeting investors as early as possible is a really smart thing to do, and moving them through the relationship spectrum from don't know you to we become acquaintances to we can talk to each other to being colleagues or maybe even friends at some point. The next point is to really practice a lot. You come off much more credible when you have a pitch nailed down. And so being able to stand in front of one person or 100 people and really knock your pitch out of the park is really important for getting that initial interest in your business. And so practice, practice, and practice. And just a reminder that you are the most credible person and the best person on the planet to tell your story and to talk about your business. So go and pitch with great confidence that you are the best person on the planet to deliver this story. You're the expert. And so go with that confidence, believe in yourself, and know that you'll be successful if you can carry that confidence with you to a pitch. There's a question on the chat about, do you have any recommendations for help with financial projections? Yeah, there are a ton of people in the startup community. You can talk to Nina or Scott, who have great expertise in building financial models. You know, I help sometimes with companies doing that as well. So the most important point of that question is that every business who tries to raise money from an investor should have a financial model. Some businesses don't believe that they need a financial model yet. And I just totally disagree. It's not that I need to see your financial model to know what your financials will look like in a year or 2 years or 3 years. It's actually that your financial model helps me understand what your business does and what you think about your business. And so I'm more interested in the way you represent your business in your financial model than if your financial model is correct in terms of projections. So I believe if you talk through people within your network, either through LinkedIn or through Project X-ITE or through, or you can contact me. My email was in the first chart of this deck. We'll get you connected to the right person to help you build a financial model if you can't do it by yourself. Okay, this last conversation, or this part of the conversation, is all about, say you have investors who are really interested in you now. What do you do? And so my advice to you is to make the investor pitch you and to do your own due diligence. And so once you've moved them through your funnel process in your fundraising journey, where you believe that they're really going to commit to your round, it is time for you to do your homework, because this is a long-term relationship. When you have an equity investor in your business, they're going to be there for the rest of your business. If they are a major investor or a board member, then you will be interacting with them a ton. And so make sure you do your own due diligence and you really talk as much as you need to the partners, to the investors, to make sure you're comfortable with them from a personality perspective, but also a philosophical perspective. It's really a good idea also to talk to other portfolio companies within the investor's portfolio. Try to find companies that they passed on and talk to them and see what that experience was like. It's never good to take just one data point and feel like that's a good data point from an investor perspective. Talk to as many people as you can who have interacted with them. The other thing you need to do is really understand what is their strategy, what is their investment criteria, what's the investment decision process. Again, so you can tailor the conversation and you can help make sure you're answering the right kinds of questions. The way you do that is by asking really, really great detailed questions of the potential investors. Another question to ask is, where are they in their fund cycle? And so it's a very different thing when an investor, a VC, is investing in the first 1 or 2 years of their fund than the last 2 or 3 years of their fund investment, or the last 1 or 2 years of their investment timeline. And so it's really important to understand where they are in that fund cycle. If you're the last company they're going to bet on in their fund, and their fund has been relatively successful, then that's a different kind of investment criteria than if you're the very first investment in their fund. The other thing you can do that's really powerful is if you talk to an investor, you've built a relationship with them, and it's just not a fit. You know, say you're a life science company and the investor just doesn't invest in life science. Feel free to ask that investor for referrals to other investors that do have that thesis that match what your business is doing. If you are on thesis for the investor and they really evaluated you and then they just passed because for whatever reason, don't ask for a referral. Because that signaling is really, really powerful. If I looked at your business and I said, we just don't have enough conviction around you, the team, the market, whatever. If I try to send that to my peer investors, it's going to be a no before they even look at it, because they're going to ask me what did I think, and I'm going to be honest with them. So asking for a referral in the right kind of circumstances can be really powerful, but if they pass on your business, then it's not a good idea to ask for other referrals. And then I have just a couple other questions that I get asked a lot, and then I'll open it up to the line for any final questions from any of you. I get asked a lot, like, how long does fundraising take? It easily takes 3 months. It could be 6 months. If you follow, the rough outline of a process that I described earlier, it's certainly in that 3 to 6 month time frame. But it starts with the early conversations, putting together your data room and your FAQs, your financial model, moving investors through your funnel, getting them more excited about your business and deeper into it. That can certainly take quite a while, which is why when you raise money, you should try to raise 18 to 24 months of runway, so that you're not trying to raise money every 6 months, because you will literally be raising money all the time. So make sure that it's going to take more time than probably you think, but make sure once you're done with the process, you've closed the round, you have enough runway where you don't need to fundraise again for quite a while. Another question, how do you know if you're ready to fundraise? Well, the reality is, as there's a huge investment ecosystem, and there's probably an investor out there who's excited about your business if you can just talk to enough people. And there's an investor for every stage. So if you've prepared well and you follow a disciplined process like we've talked about today, and you're willing to talk to a lot of people, you will probably find a group of investors who are excited about your business, despite where you are in stage and maturity. It's not uncommon for CEOs, especially at the seed or pre-seed stage, to talk to well over 100 investors before they get to a yes from a lead investor. And so just have that in the back of your mind. That's how many people, that's how many firms you need to talk to before you get to the right type and the right fit for an investor. There's something like 1,600 VC firms out there now, and easily more than that from a private equity perspective. So there are a ton of investors out there. Like I said before, more capital has been organized into venture capital and private equity than ever before in history. So there's a lot of capital looking for good investment ideas. And so you'll probably need to talk to a lot, but if you're willing to do the work to talk to a lot of investors, you'll find the ones that fit. And then we just talked about this, but on the financial model side, yes, please build a financial model. It just helps me as an investor understand how you think about your business. All right, that is what I had from a prepared statements perspective. What questions do you all have? We've got maybe 5 or 10 minutes left for questions if you have some. Here's a question on the chat. Will investors want to look at your business plan, financial projections only, and or both? It's very rare today to see somebody build an actual business plan. And by business plan, I mean in the traditional sense, like if you're going through undergrad or grad school and somebody assigns you to write a business plan, that's probably like a 20 to 50 page report that goes through the market and the financials and strategy and all those kinds of things. It's very rare for somebody to actually build a business plan. It's even more rare for somebody to send that to me as an investor. What I want to know is some of the things we talked about today, which is what do you think about the business? What do you think about the market? What do you think about the business model that works best for you, which should be represented in your financial model? And then I'm going to do my own homework as an investor to go figure out what the market looks like, where are the choke points in the supply chain or the value chain. I'm going to talk to your customers, etc. And so if it's useful for you to build a business plan to make sure everything is really thought through and articulated well, you should do that. in terms of what an investor looks for, almost no investor wants to read a 30 to 50 page business plan, but almost every investor wants to see your financial projections.
Hey, Brian, I was the one that asked earlier about any recommendations. It was kind of a broad question, but I guess I was asking more on any resources that I can model off of and look for like specific competitors in the market. I use like SimilarWeb and some other tools that you actually have to end up paying for. But any recommendations for tools would be really helpful.
You're talking specifically about financial projections, or your business's financial model?
Kind of both. I mean, just to see the numbers of really right now, I guess the problem that I'm running into specifically is with like the first 5 years of companies that are in the same space. And so just trying to figure out, how many users they've had on the website, as well as, they probably won't provide this, but the revenue for those first 5 years. And so really just trying to figure out as many resources as possible that I can base my financial model off of that.
I got it. Yeah. I haven't found a great repository for that kind of data. Like if you're building an app or a consumer facing app, I know App Annie has some data that I've looked at before. Sometimes through like CB Insights or PitchBook, you'll find some data. Sometimes in like Quora or other blogs, you'll find some nuggets of information. But what I would suggest is put down on paper in your model what you believe is true and achievable in terms of customer acquisition, ramp up, how can you monetize users, things like that. And then go talk to a bunch of investors who have exposure to businesses that are similar to yours and see if you're on the right track. So, almost every firm here in Colorado has a partner level investment professionals, and then they have principal or associates as well. And so it's very easy to get in touch with, the principals and associates and to buy them a virtual coffee now with Zoom, and just run your business model past them and see if it works, if it fits, or if it's in the ballpark. Anecdotal data from a seasoned investor's better than random data points that you're going to find on the internet, in my opinion. Mm-hmm. And so I think it's really important to just put down on paper what you believe about your business, and then go talk to as many people as you can who have experience in your kind of business and see if they agree with you.
Thank you. That's awesome.
With that question being asked, I think that sort of rounds out our time. And so, Brian, if you don't mind pointing us back to your email address, I'm sure if anybody has any follow-up questions, they'd love to reach out.
Sure.
But Brian, thank you so much for doing this with us and for being for leading this workshop. So, guys, we'll have this workshop recorded and posted to X-ITE's website and YouTube page. And then Brian's got his contact information there if you've got any follow-up questions. But thank you guys so much for participating in this. Thank you.
Yep. Thank you all. Appreciate your time.
Yeah. Thank you guys.
Brian, have a great rest of your day.
You as well, Scott. Thanks. Good to see you.
See you.